Hi there everyone, a very good evening. Welcome to The Money Show. This is the only show of its kind where we get you top financial experts, and of course we want to help you out with all your financial queries. I'm Avan Debash, and joining me on the show as always is Avni. Hi Avni.
Hi Avan, but before we get to our questions, here are the quick headlines at this hour. Some semblance of relief on D Street after 3 straight days of sell-off. Nifty reclaims the crucial 10,200 mark as value buying emerges in large cap stocks. PSU banks spearhead the gains.
Meantime, while flows into mutual funds continue to remain strong, gold ETFs continue to lose their sheen, with investors pulling out as much as 420 crores from the period of April to October 2017.
And you will soon be able to pay your shopping bills with your Aadhaar number. IDFC Bank partners with TCS Merchant Pay for Aadhaar Pay, becoming the first to enable this platform.
Those are your top headlines. Let's bring on board our guest, and he's going to guide us over the next 30 minutes. Joining in on the show, we have Nikhil Kothari, who's the CFA Director and Chief Financial Planner at Etica Wealth Management. Nikhil, lovely to have you with us on the show. We've got lots of questions pouring in, but let's discuss an important topic of discussion that merits quite a bit of attention. Some classic mistakes that investors make when looking at putting their money into mutual funds, and that can land you in a soup, maybe not at the time, but in the long haul. So can you highlight some of them and tell us how investors can overcome some of these classic mistakes?
Right. So most of the time what we've seen is that when we do investing, we do few very basic mistake. The first mistake what we always say is that not investing with a goal in mind. Whenever we start a journey, whenever we start a vacation, we always first think about a destination, and accordingly we select that which mode of travel we'll follow, what packing we need to do for the vacation. Similarly, when you're investing, you should always have a goal in mind, that this goal is for short term, this goal is for long term. So goal can be in various ways. It can be child's education, child's marriage, my own retirement, my holiday home. So whenever you're investing, once you have a goal in mind, if the goal is for short term, you need to invest in debt, and if your goal is for long term, you need to invest in equity. So but before investing, first always make sure that you have a goal in mind. The second common mistake, what we normally say, is that people do panic when the markets are volatile. Whenever you're investing in equity, you should be aware that equity markets will be volatile in the short term, but in the long term, we see that equity will give you a very handsome return. But since we don't have a goal in mind, and we don't have a patience, normally what happens is that when the markets are volatile and the markets are going down, we keep on panicking on that. And we panic and we take out money when the markets are down, and we don't really enjoy the fruit for the equity market. The third mistake which you normally do is to mix insurance and investments. The principle which you always follow is that when it comes to insurance, you should always take a term insurance, which is a pure insurance. When it comes to investing, you should always invest with your goal in mind. If it's for short term, invest in debt. If it's for long term, invest in equity. So never combine insurance and investment. The fourth goal is that over diversifying your portfolio. So when we meet a lot of times, we say that, okay, should I put 10 funds in my portfolio, or should I do 20 funds in my portfolio? You should only have 4 to 5 funds in your portfolio. That's good enough for your investing. You should have funds from different baskets. So you can have one large cap fund, one mid cap, one small cap, one multi cap. So this should be a broad diversification, but don't add too many funds of the same flavor. So don't add 4 large cap funds or 4 mid cap funds in your portfolio. And the last most important is that churn your portfolio. So a lot of times what people say is that people do churning of the portfolio in the name of rebalancing. So what we say is that you should rebalance, you should look at your portfolio, review your portfolio, but doesn't mean that you always try to catch up the best performing fund. What is the best performing fund in the last 1 year may not be the best performing fund in the next year. What you need to do is that when you select a fund, look at this consistent track record. If the fund is doing good for a reasonable period of time, short-term fluctuation or short-term bad performance do not warrant a redemption of the fund. You should, if the fund manager is same, if the philosophy is same, just hold on to the investment. If you hold for long term, you will always make money. And before buying a fund, do the research and look for funds which are consistent. But don't always try to chase the best performing funds.
Right, Nikhil, some extremely crucial and important points for investors to keep in mind, namely investing without a goal in mind, withdrawing when markets are volatile, mixing insurance and investments, over diversification of portfolio, and importantly, hunting for the best performing fund. These are some of the mistakes, very common mistakes that a lot of people make, which you should avoid, as Nikhil just said. Well, the first question, Nikhil, comes in from Mahesh, who says, I have currently invested in the following mutual funds. Please review my portfolio and advise if I should make any changes or stay invested in these funds for the long term. And among his funds, he has SBI Blue Chip Fund, Aditya Birla Frontline Fund, ICICI Prudential Value Discovery, Franklin India High Growth, and Franklin India Smaller Companies Fund. What would be your advice to him for his question? And specifically, if you could tell us of the funds that he has, which ones should he hold on to, and if there are any he should exit?
First of all his funds are equity fund. So I'm assuming that he wants to invest for long term, and the minimum horizon when he's investing in this fund should be 7 years and plus. So that should be the first parameter. Then comes on a specific fund, like if I look at his portfolio, he has the SBI Blue Chip Fund as well as Birla Frontline Equity Fund. Both this fund are large cap fund. So SBI Blue Chip Fund invests 80% in large cap stocks and 20% in mid cap stocks, whereas the Birla Frontline Equity Fund basically invests in BSE top 200 stocks. So both these are good fund performing fund, but both are in large cap category. So I'll recommend that he can have one large cap fund in his portfolio instead of having two large cap fund. So you can try to consolidate in one fund. You can look at Birla Frontline Equity Fund to consolidate that portfolio. Then it comes to ICICI Value Discovery Fund. It's a value oriented strategy. So basically it buys stocks which are not in the flavor right now, but likely to outperform in the long term and try to get out from the current scope of things and may perform better in the long term. So he has one ICICI Value Discovery Fund. It's a multi-cap fund. He can remain invested in that fund. Then you have a Franklin India High Growth Companies Fund. So it's a complementary to ICICI Value Discovery Fund. ICICI is a value fund, whereas a High Growth is a growth oriented fund, and which is also a multi-cap fund. He can remain invested in both this fund. But when investing High Growth Companies Fund, he should be aware that there will be good amount of 40-50% large mid-cap stocks. So it's maybe slightly volatile, but again in the long term, if the growth story continues, you can expect good return in this fund. Lastly, he had a Franklin India Smaller Companies Fund. Smaller Companies Fund basically invests in small cap stocks. So when we know, so in the long term, small cap do outperform the large cap, but they will be more volatile, they will be more riskier. So when you're investing in small cap companies fund, you should be aware that your horizon should be very, very long term, and you should be able to withstand the short term volatility. So overall, he can remain invested in this fund also. So I'll say consider in the large cap space instead of Birla and SBI, and rest of the fund he can continue to hold on that.
Okay, that's the advice coming in on your entire portfolio. Do remember that you can stay invested in some of these funds, and he's also given you some recommendations as to how you can prune the portfolio better. Identifying your goals will be a fairly crucial step, and look to hold on to some of these stocks, or rather some of these funds, for the long-term horizon. Next up, we have a query coming in from Sujit, and he asks, which is a good contra mutual fund for me to invest in for the long term? And can you tell me the benefits of investing in a contra fund? So break it down for us really, Nikhil. What exactly is a contra fund? How much different is it from, the regular large cap mutual funds? And do you think that there are some good names out there?
Okay, so Contra Fund as a strategy is very, very good. What they do is that they buy stocks which are out of the flavor in the market right now, but the expectation is that they will likely do good in the long term. So to give example, recent example, so like say for example, the pharma industry right now is going through a different phase, or IT industry is not going through a very, very growth oriented phase. So this stocks may be down in the current juncture in terms of IC, say for example in case of Infosys, or in case of Sun Pharma's on this world. So these are contra stocks because they're not doing good in the current juncture because they have some regulatory issues or some management issue in the company. But the expectation is that once this things are out of the way, these companies will likely do very, very good. And because of this restrictions, or because of this management issues, or maybe of the regulatory issues, they are underperforming right now. And from a valuation perspective, they are deeply undervalued. So Contra Fund basically do is that they identify these opportunities and go and invest in this type of stocks. Now, when you're investing in this type of fund, you should be aware that this may not turn out to be favorable in next 1 year, 2 year, 3 year. Contra funds takes a good amount of time. So basically, when you're investing in contra fund, you should have a long horizon, and you should be able to stay invested for that period of time to get the benefit out of it. So normally, which we normally say, most of the in the industry wise, most of the funds will be more of a growth oriented or blend approach. There are only very few specific fund will follow a contra approach. So in your overall diversified portfolio, you can have one contra fund as a supplementary to your overall portfolio. Now, but you should not have like 100% of your money in the contra fund. You should have only 10 to 15% of your allocation contra fund. In market, there are there's a one contra fund called as SBI contra fund. There's a Invesco India value fund or contra fund. That is a very good fund. So I'll say that if you want to invest in one of this fund, you can take an Invesco contra fund, but again have a very clear horizon that you should have a long-term horizon for this fund, and this will not be performing in line with your other diversified fund. So you cannot compare a large cap diversified fund to a contra fund.
Right. Nikhil, just a quick follow-up. As far as contra funds are concerned, would it be advisable for maybe slightly more experienced investors to really opt for them rather than for beginners? Because at the end of the day, taking contra bets may not always pay off in the time horizon that you really have in mind.
Yeah, so this is a thematic type of fund. So if it's a first-time investor, I would rather buy a diversified multi-cap fund which will perform in all segments. Whether it's a contra is doing good, or value is doing good, or growth is doing good, it will perform in all the segments. But contra is a very specific theme. So someone who wants to have a view that, okay, though the stocks or the sector is out of the flavor right now, but he has a view that this sectors will likely perform in the long term, then only he can bet on this fund. So it's basically meant for savvy investor who can identify those trends right now and then invest in this type of fund. So again, as I told you, that it may not be performing as compared to diversified fund. So if you're a first-time investor, be invested in diversified-oriented equity fund. If you are a savvy investor, then you can allocate 5 to 10% of your portfolio in a contra-oriented strategy.
Thanks for that, Nikhil. Tell you what, we'll slip into a quick break right here on the show. Stay with us. We got lots more queries that we will be answering, getting in some live calls as well. We'll be addressing those.
Welcome back. You're watching The Money Show, and we have with us in the studio Nikhil Kothari to answer all of your questions. Well, our next caller is Ashwin, who's calling us all the way from Australia and has a question for Nikhil. Hi Ashwin, thanks so much for tuning in to The Money Show from Australia. Tell us, what is your question?
Hi, so thanks for having me. Obviously, you have your viewers from the land down under. I had two specific questions. Two questions for Nikhil. One was generic, the other was specific. The first question was, how can NRIs participate in the ETF market from overseas?
Okay.
And second question was a little bit more specific. Given we are not across day-to-day happenings in the market, what kind of funds would Nikhil recommend to the NRI investors?
All right. Well, Nikhil, what would be your advice as far as NRIs specifically are concerned, and specifically what funds, if you have any recommendations for Ashwin?
Great. So NRI can invest in ETF. The only thing is that when you're investing in ETF, you need to have a demat account. Okay, so as an NRI, they need to open an NRI or NRO demat account. Now, when you're opening a demat account in India, you need to open a separate bank account called a PINS account. Okay, so as an NRI, you need to open a PINS account. That's a banking account, and then you have to open a demat account. Once you have those two in place, then you can invest in all the ETFs available in Indian markets. So that's the one-time paperwork which is required, and next time then everything can happen online. With regard to specific questions on what funds to invest in, now since you're not regularly tracking the Indian markets, so investing directly in stocks may not be a great thing for you. So it's better that they invest in Indian equity market through mutual funds, because mutual fund will give them professional management, and they can also invest across a wide variety of funds. Now specific to your goals, if you have a horizon, if you want to invest in equity market, if your horizon which is more than 5 years plus, say that you can invest in diversified equity fund. Now you can have a basket of 3-4 funds in your portfolio. So you can have one large cap fund, one multi-cap fund, one mid-cap fund, and maybe one small cap fund if it requires. So that can be a broad basket of funds. If you want specific fund on the large cap space, you can look at, say, Mid India Opportunity Fund or Birla Frontline Equity Fund. On a mid-cap space, you can look at DSP Small and Mid-Cap Fund or Mid India Emerging Blue Chip Fund. On a multi-cap space, you can look at Kotak Select Focus Fund or IDFC Classic Equity Fund. And if you want a specific small cap which is more riskier, then you can look at DSP Micro Cap Fund. So you have wide variety of funds. As an Australian investor, you can invest in all these funds. There's no restriction on which fund house you can invest in, and you don't need to have a demat account to investing in Indian mutual funds. The only thing is that you need your Indian PAN card, you need an NRE account, and you need your visa or your passport copy and your international address proof.
Right. Ashwin, I'm just going to ask Nikhil a follow-up on your behalf. Nikhil, as far as, Ashwin, for example, somebody like Ashwin who's perhaps bullish on the India growth story per se, and between ETFs and index funds, what would be your recommendation?
So ETF funds are so basically the ETF funds and index funds are more or less same. If you already have a demat account, then ETF will be better for you because the cost of investing in ETF is lower than index fund because there's a fund management charges. But if you don't have a demat account, then it's better to invest in an index fund. Now I'll say that instead of investing purely in index fund, I'll rather recommend him to invest in active managed diversified equity fund, because in the Indian markets there's a huge amount of alpha when it comes to active fund manager, and we have seen that active fund managers outperform the index fund by hands down. So I'll say that he can look at some index fund, because in Australia and in developed markets index funds perform similar to active managed fund, but Indian markets active managed fund outperform the index fund. So I'll rather say that invest in active managed equity fund, and if you want to invest in specific index, then you can look at ETFs as a investment options.
Okay, thanks so much for connecting with us. It really makes us proud when we know we're being watched all over the world, including Australia. So, Ashwin, hope we had Nikhil give you, an explicit answer as to the options for ETFs and as well as your personalized options that you can look to invest in. I just want to tell all of our viewers, we are getting all of your calls. If we don't take your queries today, we promise that we will take it tomorrow at the same time on The Money Show. Nikhil, before we let you go, mutual funds, a lot of people want to invest in them for the short haul, not a very long period of time. What would you advise them to do in this case?
So a lot of people think that mutual fund is equities. Mutual fund is not equities. It's a vehicle to invest in different asset class. So through mutual fund, you can invest for short term also. Now in short term, when you're investing for short term, you should invest in debt securities. Now in mutual fund, there are a wide variety of debt funds. So if your horizon is less than 1 year or 6 months to 6 months, then you can invest in liquid or ultra short term funds. So which invest in money market instruments. If your horizon is say 6 months to 1 year, then you can invest in low duration funds. Though this fund invest in paper which are maturing next 6 months to 1 year to 1.5 year. So they will be less volatile when it comes to interest rate, and they will give you slightly better return than a liquid or ultra short term funds. If your horizon is 1 to 3 year, then I'll say, and you want return in line with your fixed deposit and willing to take slightly interest rate risk, then you should invest in short term fund. Short term fund will give you return in line with your fixed deposit. And if your horizon is 3 years and above, which is 3 years to 5 years, and you want a safety of capital, then you should invest in short-term debt fund or a credit fund. Now, this fund invests in corporate papers which are maturing next 1 to 5 years. So, and the good part when you're investing in debt fund in India is that if you're investing for more than 3 years, you get indexation benefit. So, when you're investing in FDs, you pay 30% tax on your interest. If you belong to 30% tax bracket. But if you're investing in debt mutual fund and if you hold for more than 3 years, so after 3 years you only pay taxes when your return is more than inflation. If your return is less than inflation, you do not pay any taxes, and if your return is more than inflation, whatever it is more, on that you pay 20% tax. So you pay very low tax as compared to your traditional deposits. So I'll say that if you belong to 30% tax bracket and you want to invest for more than 3 years and want return in line with fixed deposit, you can invest in short-term debt funds.
All right. Well, those are some extremely crucial points Nikhil was just mentioning, as far as, and importantly to remember that short term means one month to 4 years. Anything more than that is considered long term, but until then it's considered as short term investments. But on that note, Nikhil, thank you so much for joining us and taking all those queries. That's a wrap on this edition of The Money Show, but we'll be back tomorrow.